Welcome back to the Independent Investor Channel. My name is Ryan. This is one of the most common questions that I get. A lot of people out there want to know what to invest in, all right? And in this video, we're going to talk about stocks versus ETFs. Now, if I were going to summarize the different products that you could enter into, certainly bonds would need to be introduced to the conversation. Index funds as well, which are similar to ETFs, and finally mutual funds, which I feel like is the least attractive. It's something that I've invested in my past. I don't invest in them at all anymore. I do, however, invest in ETFs and stock. So this is going to reflect both the active profile on the single stock side, as well as address the passive side of the house through ETFs, okay? And a lot of people will come and they'll ask me, should I buy Vanguard ETFs? Should I buy Charles Schwab ETFs? Should I buy no-cost ETFs? I'm not going to get into that on this video because I think the majority of that deliberation really does split hairs. I think a lot of passive ETFs, especially some of the broader market like the S&P 500 or the Russell 2000 or even the NASDAQ that's a little more tech heavy, those products are going to get it done for you, okay? Those are designed to be passive in nature, own pieces of those market, whether it be cap-weighted ETFs, or equal-weighted ETFs, but those are going to give you that passive, diversified exposure to the market, and it's going to do so at a very, very low cost. And for those investors that are part of my community, they know how much emphasis I put on fee reduction. And so that's typically why I would justify going with an ETF. Now, for you guys that know me, you know that I really do strive for a 50-50 mix in my portfolio. What I mean by that is I'm looking for 50% of my portfolio to be comprised of dividend growth stocks, okay? I do have a small portion of aggressive growth, that of which I cover in videos through the chronicle of the channel. But for the purposes of the bulk of my wealth, I really do strive toward a 50-50 allocation. And that really does speak to how I feel about both programs, okay? One being passive in nature, one being active in nature. We'll talk about the passive avenue first. A lot of people really want to know what the best stock out there is to buy. They're looking for that best thing. And they're looking to find that stock that is going to appreciate quickly in value. Passive investing isn't like that. You really are buying a lot of different pieces of a particular index, like the S&P 500, for example. It's comprised of 516 companies. So when we talk about the Vanguard's ETF or VOO, you're basically buying that one ETF and housing it in your account. But that one ETF that you own gives you exposure broad-based to those 516 companies. And basically, you're going to have the bulk of your money, it's called a cap-weighted ETF, the bulk of your money is going to be comprised in the larger companies, and then the smallest amount of allocation is going to be in the 516th company. So from 516 to company 1, you basically own the entire stock market. And that's a great way to think about initial exposure to the market. So I absolutely want to convey that for the new investor, that broad-based diversification right up front can really give you a lot of bang for your buck. And a lot of people are turned off by ETFs by saying, well, they're diluted, they're watered down. Why not just buy the top 10 in each of the ETFs? Certainly you can do that, but by cherry picking the stock market, you're losing out on diversification. Now, what is your strategic goal by owning ETFs? The strategic goal of owning ETFs is to gain that year-over-year performance in the stock market. So you're going to go through ups and downs throughout the course of a day of investing, throughout the course of a week or month or years, okay? The idea is that you own those products long-term, which means that you don't have to watch them. You own them passively. It's called sleepy money. It means that you invest in those companies broadly through the ETF, and you don't have to worry about selling to take profits. You don't have to worry about stop lossing. You don't even have to worry about doing any company research, because the idea is that you buy the broad-based market, and through entering into that diversification, you're basically buying insulation through buying that broad-based ETF. So for those beginning investors that don't want to do their homework, or more importantly, there's a lot of investors out there who don't have the time, a passive investing portfolio can really be the answer for you. And I will just finally add this. If you do buy that S&P 500, it doesn't mean that you have a complete portfolio, okay? You do own those 516 companies. Yes, I will agree. But what you don't have is exposure to the small cap, the Russell 2000 market. You don't have broad international exposure. And there's certain products out there through ETF investing that can allow you that global perspective and build some global diversification into your portfolio. So that's the passive side of the house. Now, the stock side of the house is much more sexy. This is what people always want to know. Ryan, I want the single stocks. I want those high dividend payers, or even worse, in some cases, I want all the growth stocks in my portfolio. I want every dollar that I have in growth stocks. And I don't think we provide enough acknowledgement, especially along the YouTube community, on how aggressive single stock investing really is. And I don't care if you're buying value stocks or not. Here's why. You look to craft a portfolio of 25 to 30 good dividend paying stocks, and you may own those stocks for the long term. Good on you. It is very, very unlikely that you're going to own those stocks over the course of that 20, 30, 40-year investing time horizon and not have a bad apple in the group. You're going to have a stock that goes through any number of things that a company that is being aggressive on innovation or staying ahead or crafting their company around their dividend to continue to pay those dividends to shareholders isn't going to trip up. And in a lot of cases, for example, like General Electric and Kraft Heinz Food, just a couple examples of some very, very poor accounting scandals behind the scenes that would not be evident to a shareholder or somebody who's looking at what's publicly available for the company. But you do take on that risk when you are entering into some of these single companies, and you're betting on those companies performing over the long run or underperforming on the long run. So where it differs in the passive approach is you really need to understand the companies through and through to the best of your ability, but also acknowledging that by entering into single stock, you're really only giving yourself 25 or 30 shots at making it. And the chances of having each and every one of those 25 to 30 outperform over the long term is very, very difficult to do. So although I do contend you have probably a better chance at some modest outperformance compared to the S&P 500 over the long term, you really do need to be open and recognize that that 30 stock portfolio is probably going to perform a lot more volatile than the broad market, because you don't have the insulation of diversification. You don't have that protection of owning hundreds, and in a lot of cases with passive investing, you can actually have exposure to thousands of different companies, and you own small pieces of those. So where hundreds of companies could go bad on you in passive investing, if you have one bad apple in your portfolio and it doesn't perform well for a couple of years, it's really going to drag on the portfolio. So where that group of stock holdings has the chance of outperformance over time, you really need to acknowledge that you may have to go through some years of actual underperformance to realize the overall goal of that portfolio. Now, I will add there's some really interesting positives to stock investing that I will offer. I think through doing your research, I really do think it's positive to pick winners. I really do. Now, stock picking is really, really difficult. That's why a lot of new investors come to YouTube and they're looking for that next best thing. and I am not one of those channels to provide the next best thing. As a value investor, I'm looking at those companies that have staying power. I'm looking at those companies that have rewarded shareholders for a track record of sometimes upwards of multiple decades, right? So we're scouring over the aristocrats, the achievers, and the kings list. We're investing in those companies that have extremely wide moats, that are very, very defensive in nature. And even by doing so, we still run that risk of underperformance, because not every stock is going to outperform, especially on the value side of the house. What gets missed all the time is the value of dividend growth. And the dividend growth piece is the aspect that really beats the S&P 500. And here's why. S&P is going to render about 2% of a dividend yield by owning that product that I talked about through the S&P 500 passively. But if you are grouping a single stock portfolio, you can really comb over the 11 sectors and build yourself something really respectable that can really increase that dividend income. And I think you could probably push it to 3 or 4%. I think once it gets above 4%, it gets a little bit tougher, and I think the quality starts to lean out. But I think from 3 to 4%, I think that's doable. A lot of the quality dividends that I've seen on a lot of those quality stocks, I think you're going to have to kind of even maybe go down to 2.5% to pick that up. But even that, you're still getting a higher than average yield than the broad market through the S&P 500. So those single stocks really do have the opportunity to give you that chance of outperformance. Just a couple things I'll mention in closing. I think people out there who have a 401k or an existing employer-sponsored retirement account, or maybe is eligible for a pension someday, I think that can really set you up and drive some of the decisions that you could make on answering the question whether or not you should invest in stocks or ETFs. I think it can help you in your deliberation, in that if you have a pretty good passive base in the 401k, perhaps maybe it's time to branch out and maybe expose some of your wealth, if not in part of your wealth, to a single stock dividend portfolio of some good blue chips. That'll be a really, really good start for you. And I think it's really important to acknowledge all this discussion about what product to buy. I really think it comes down to an individual basis. I really think it comes down to defining your risk, to putting to risk, your percentage of risk. How much risk do you want to put to risk in the stock market? I think that's super important. Do you want to be a little bit more aggressive with your allocation or the amount of money that you put to risk in the stock market by becoming a participant in the market? I think that's super, super important, but not to be overshadowed by the importance of what I contend on the Independent Investor channel, that no matter what product you are looking to enter, whether it be single stock or ETF, the importance of tax protecting your money and wealth preserving your money over time with the reduction of and the vast or the drastic elimination of fees over your money is really the key drivers and probably paramount in the decision making that you're going to make for building wealth for you and your families. You really need to take that into consideration, and I would contend that it's more important in how you build wealth than the actual makeup of the stock or ETFs within your portfolio. Guys, thank you so much for tuning into this video. You want to make sure and hit the subscribe button for me. Leave your comments at the bottom of this video. Certainly, it's a question that I get all the time. Should I invest in ETFs or stock or bonds or mutual funds or index funds? It's certainly one of those discussions that will continue. We'll continue to foster the dialogue on this topic, guys. Share the message with those folks out there that are looking to get some introductory information on the stock market. Please bring them onto the channel. We'll take care of them. Maybe provide some motivation that they're looking for to get started on a wealth building path for themselves. Guy, thank you so much for tuning into the message, and good luck in your investment future.